Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 51 on March 2nd, 2019. I'm your host, Eric. And in this week's show, we will cover the trades from last week on GoPro, MetLife, and Micron Technology. And we discussed three new trades on Fitbit, the S&P 500 Index ETF, and Toll Brothers. Now, it's always great to hear from listeners, so if you have any questions about the trades presented here or on the show, or about your own positions, feel free to email me. You can reach me at eric@theweeklyoption.com. That's ERIC at theweeklyoption.com. And I've also created a short video series to teach you all the basics of option trading that you'll need to know in order to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or just find our channel on YouTube for the Weekly Option. And as a side note, I received a couple of emails from you guys this week, so if you sent me an email and I have not responded, don't worry, I still will, likely this weekend. It just was a busy week in the market and had a couple of other things to take care of, but wanted to make sure that I took the right amount of time to respond to your questions, so I didn't send you a quick response, but I will get back to you this week, so thanks again for writing. Now, the equity markets finished the week fairly close to unchanged once again. It's like our second or third week in a row. The Dow Jones Industrial Average inched 5 points lower to end the week at 26,026 points. The S&P 500 index grew 11 points, closing at 2,803 points. But both of these were essentially unchanged, significantly less than even 1% on the week-over-week growth. Now, this week, there are 365 publicly traded companies in the United States that will announce quarterly earnings. On Tuesday, I will listen for earnings on Target and Kohl. On Wednesday, we'll hear from Abercrombie and Fitch and American Eagle. On Thursday, H&R Block, Barnes & Noble, Costco, and Kroger will report quarterly earnings. And then on Friday, I will listen to Vail Resorts earnings. And I like Vail Resorts, especially this time of the year, because I love to ski. If you guys are ever going to the mountain and think you might have some time to catch up with me, shoot me an email because I might be there. I try to sneak away when possible. Not as often as I like this year, but in years past, I've been known to ski quite a few days. So, and as well, if you noticed in the companies that I'm listening for this week for earnings, several of them are sort of consumer brands. And I like looking at consumer brand quarterly data because oftentimes their numbers will give you a better indication of how the economy is really doing. We have a consumption-based economy here in the U.S. And so if you follow the retailers, you'll get a good sense of where people are spending their money, or if they're starting to save more, which could also be an indication that that tough times are coming. So savings are good, but normally in times of greater wealth, like let's say you increase your income, or you start trading and you're knocking out just massive profits in the markets. Most people, even if they increase their savings amount, they will also increase their consumption a bit. And so it's the fluctuations in consumption that can precede real lags in the economy, and it's a great indicator of recession or prosperity for that matter. So that's it. Didn't really plan on tossing in a little bit of economic or a little economics course there, but I studied economics as an undergraduate at the University of Texas in Austin, and I am happy that I did because it gave me a model, a framework, if you will, of viewing the economy and changes in the economy, and that really that served me well when I became a commodity trader. I've traded, spent a long time in crude oil, not crude oil, but in the crude markets, in fuel, gasoline and ethanol and whatnot. But also, I had a period where I was able to trade steel for a little bit, like metal, steel. So, the way commodity markets work, and my economic framework fit well, looking at supply and demand, and then being able to better understand the triggers that both move supply or move the demand curve, and also being able to look at a market and really tell who is in control. Is this a supply driven market or is it a demand driven one? And so when it comes to viewing the news, and this is what's important for everyone else, it's when you read worldwide economic events, when one country rather changes its interest rates, it doesn't just matter for that country, right? An interest rate change in, say, Brazil will still have an effect on the U.S. economy. A shift in U.S. economy interest rates at the federal level will certainly affect, what do you call it? Japan's economy, China's economy, the European Union. So it really gave me, again, economics gave me a framework for putting these things into context and trying to get a sense of how it's ultimately going to affect the markets that are traded here, or whichever markets you focus on. So I'm always a fan of people increasing their education. So many good books on economics out there. You can go the route of reading, some of the hardcore. You've got Wealth of Nations, Adam Smith's writing that really is the basis for much of the economic theory of today. But there are so many great economics books out there that you could still be both entertained while being educated. Books like Freakonomics, which, is almost cliche to even mention, but there are a lot of just economic nuggets right in there that could actually improve your trading, because it'll help give you a framework by which you can just analyze news, analyze markets, and look for the not the surface level, not the superficial results, but what are the second and third level? What are the derivative effects of this decision, and how is it going to affect my portfolio? So, all of that being said, let's dive into the topic of the week. So, this week I wanted to make it as simple as possible, and that is the importance of understanding a single option. The way I look at options, and you'll hear it in this show every week, certainly if you follow along enough, and then the folks that sign up for the class that I do online, what do you call it? The Option Studio. We look at options starting as a single option and understand it. It is a building block. So whenever I'm speaking about spreads, what I really see in my mind are two Legos stuck together. I can always pull those Legos apart. It doesn't matter how many Legos I stick together. Each Lego is still very much an individual Lego. And hopefully that analogy works, but if it doesn't, sorry. When it comes down to it, though, any option structure, portfolio, or spread, no matter how many options it's comprised of, it all comes back to every single option. Every single option on its own still contributes its individual factors to the portfolio, right? So the way that plays out is this: you're able to break down larger positions into its individual components and actually analyze the position individually. And that's huge for some people. Some people might not understand, but I had a conversation this week with someone who is looking at, say, butterfly spreads, which a butterfly is comprised of 4 options where across 3 strikes, let's say you buy 1 strike, you sell the next 2 strikes, and then you buy the outside strike. That's 4 options that you could actually view as one butterfly spread, or you could view them as 2 consecutive spreads where you both buy and sell an option at each strike. There are ways to look at options. A 4 option spread still profits or loses money based on the individual options. So when you get really good at understanding options, you will be able to look at your position in the composite, and it's great to be able to look at it in the composite. And I mean, if you guys have been in options for a long time, I'm sure you've seen massive volatility graphs and these 3D position payoff models that people build, and they're great and tricky and complicated, and you may pat yourself on the back for being able to understand them. And trust me, I'm there. I've got I'm looking right now at my library, and I have some pretty kind of heady option books that at one point would have made my eyes cross, and now I actually find them kind of fun and entertaining. But that being said, it all comes down to, do you understand what's happening with each individual option in your portfolio and how it is affecting your profit or your loss? Because if you can break it down to one option, if you can break it down to individual options, then you have a great chance at figuring out what the best adjustment is to either lock in profit or to minimize loss. So, and I'm gonna, in today's explanation, the review of trades, I'm going to discuss a few things that I really don't talk about on the show too often. But again, if you understand how a call option profits or losses, or a put option makes or loses money, then you can find ways to put yourself in a situation where you make money. So for those of you who want help visualizing this concept, I actually created and offered a while back a option payoff graph. It's in a Excel spreadsheet, and it's great. It's a great way to be able to both visualize option positions that I talk about on the show, or to visualize trades that you're considering putting on in the market. And it's created using very simple. It's very simply made. And I actually leave all of the formulas visible so that, because sure, I could code it up in like VBA or use a couple of other languages that work with Excel, and send it as a closed sort of model. But the equations are left visible so that you can look and see that I really do look at how each option profits or makes or loses money at every future price, and it all aggregates to create that graph. And that's the way you should look at your option position. So again, I talked about weeks ago, keeping it simple. Even when you have a complicated trading strategy, break it back down to the individual option blocks, and you will find a way to make money. So that's it. So let's dive into the results from last week. And this week's results were certainly not my best showing. I managed to sell a call spread, buy a call spread, and managed to lose money on both of them. So I tell you, that takes skill. And part of the joy of sharing trades each week on this show is that, it's very humbling to have to discuss results, right? It's easier when you make money, or you can make money in public but lose money in private. You know what I mean? But that being said, I think you guys actually get a lot more out of the shows where I do lose money in that given week, because then you get to hear how I will adjust the trades And that's where the learning is. So prepare to learn a lot this week, because we're going to talk about ways to mitigate trade losses. So let's start off with the covered call. We looked at GoPro, symbol GPRO, George, Paul, Richard, Oscar. The stock at the time was trading for $6.21. And I looked at buying stock and selling the March 6.5 call at 13 cents. The goal was 6.76% return over 3 weeks, because March expiration at the time was 3 weeks away. Well, GoPro shares finished the week 13 cents lower, ending at $6.08. So that also represents 608 was actually our break-even point for the trade. So the stock fell 13 cents. And the option right now, so the option that we sold also decreased in value. We can repurchase that option right now for 8 cents, which locks in a 5-cent gain in the option. So all in, this trade cost us 8 cents this week. We were at an 8-cent loss, and we are sitting at the break-even point. Now, given the lack of significant price movement in the U.S. equity markets over the last couple of weeks, I'm less inclined to keep this one going. I'd be more comfortable exiting and just looking for another opportunity. This may very well work. And normally on a covered call situation, we would look at buying in an option. Like if the stock moved against us, we would buy that option in and sell lower. But since it moved so little, or had such a small movement, we're still really looking at the very same strike. And so this isn't a situation, this isn't really an opportunity where you can do that. So if I had to decide, should I stay or should I go? I'd probably exit this one and just look for another opportunity. Now, the credit spread. All right, the credit spread we looked at last week, which is a spread that we sell, was on MetLife, symbol MET, Michael Edward Thomas. The stock at the time was $44.74, and we looked at selling the March 45 half call spread at 15 cents. That would create a maximum loss, of course, of 35 cents, since this is a 50-cent wide spread. Well, MetLife stock rose 81 cents this week, so it ended at $45.55 per share. The out-of-the-money spread, which we sold, is now in the money, and we sold it for 15 cents with 35 cents at risk. Right now, we can buy the spread back for a total of 36 cents on a 50-cent spread, of course, and that represents a loss of 21 cents per spread. Now, because the spread is now in the money, we know that if stock stays here or goes higher, this spread will be priced at 50 cents at expiration. So rather than lose the full, the maximum loss, that 35 cents we discussed, I would look at buying the spread back and locking in a loss of 21 cents. Now, the stock appears to be pushing right up against sustained resistance. If you look at a MetLife chart, you'll see 3 or 4 different points. I believe this is the 4th time where there's sustained resistance at $46 per share. So for those of you who like risk, you can recover that 21 cents by selling 2 of the 46 half 47 call spreads at 10 cents each. Now, as tempting as it is to sell 2 of those spreads and collect 20 cents to lower your 21 cent loss down to 1 cent, I wouldn't necessarily advise it unless you really understand what you're doing and commit to watching this stock price. And that's because sometimes it's better to take a loss than to double down on your risk. So while you be collecting 20 cents a premium, you're also entering into essentially a position that could cost you 80 cents, right? You're selling 2 50-cent wide spreads and collecting 10 cents each simply to collect your premium. Now, granted, they're a good dollar plus out of the money, but still you have to keep an eye on this one. I do expect that $46 resistance to hold, but if it does break that resistance, we could see a nice $2 or $3 pop in stock, which would mean that both of those spreads would be in the money, and you would only add to and multiply your losses rather than truly mitigate it. So maybe hold off a little bit, see what stock is going to do, and then maybe look at other options, or other trades that you can enter to mitigate any loss on this. But yeah, I kind of, every now and then I like taking a bit more of a swing. I mean, at the end of the day, I'm less concerned about losing, what do you call it, 21 cents, which equates to $21, because each spread still represents 100 shares. So I'm less concerned about losing $21 per spread. But sometimes I just like being right. And it might end up being worthwhile to go ahead and sell two higher level call spreads to bring my money back in. So we'll see. If you have any questions of that, 'cause it certainly changes your risk, feel free to email me. Now, the final trade from last week was the debit spread. We looked at Micron Technology, symbol MU, Michael Uncle. At the time, the stock was trading for $42.57. And we looked at buying the March 42 half call spread for 34 cents, which creates a maximum gain scenario of 16 cents or 47% in 3 weeks. Now, Micron Technology fell 99 cents this week, ending at $41.48 per share. The in-the-money call spread, which we bought, is now out of the money. So the spread is valued today at 19 cents, leaving us with a 15-cent loss on the week. Now, the March 44 half call spread is trading for 10 cents. Once again, you can sell two of these spreads and cover your loss. The danger, of course, is a big up move in the stock over the next 2 weeks could really multiply your losses. So I would lean towards selling a call spread and a put spread together, which creates an iron condor. And you compare selling the March 44 half call spread with also selling the 39 half put spread, both of course in the month of March, collecting 10 cents each for each. Now, the spreads are both far enough out of the money to offer a little bit of safety over the next 2 weeks, but anything can happen. And if you choose to adjust your trade in a way that significantly alters your previous risk profile, make sure you understand the ramifications of your actions. If you sell the iron condor, you're collecting 20 cents, but could ultimately lose 50 cents. And if neither trade finishes in the money, you'll get to keep the 20 cents and walk away with a net profit of 5 cents for Micron Technology in the month of March. And that's it would be due to the 15-cent loss that we're locking in from this week's trade. So there are also a couple of scenarios where you could sell ratio spreads, where you sell two options and buy one, and the two options actually pay for the one that you buy. Ultimately, again, you're changing your risk profile, not necessarily multiplying it, but certainly changing it. And you need to be able to understand what's happening with that trade before you make that decision, right? So you have multiple decisions. The first one is, do I stay in this trade or do I exit? And so I'm saying I would exit the trade, but then I would also look at putting on another trade that has 2 weeks left in the market, looking at putting on another trade that will allow me to regain the money that the market has taken from me thus far. I do not like giving money to the market, and I also, as I mentioned, like being right, and trading allows me to fight back. So that's it for this week's trade. It's funny how you'll have weeks like this, and I'm certainly exposed, where the markets hardly do anything. I mean, the S&P moved 11 points. The Dow Jones finished the week down 5 points. I mean, 5 points on a 26,000 point index. And here I managed to have two trades that moved 70 cents, moved significantly for both, and cost me money on both my options positions. So that's the way the cookie crumbles every now and then. So you can always choose to buy another cookie or, in this case, sell more cookies. And sorry, I'm a bit cheesy this morning. I'll try to behave and stay on task. Let's see. Let's look at the trades for this week. So this week we'll start off as usual with the covered call. And I'm actually, for two of the trades, I'm going to be looking at companies that announced earnings this past week. So once again, it's a reason to follow along with earnings and figure out which companies are producing earnings every week, because there are trades you can do before they announce, and there are trades that you can look at after they announce. In this scenario, I'm looking at a covered call on Fitbit, symbol FIT, Frank Isaac Thomas. The stock ended the week at $6.14. And I'm looking at buying that stock and selling the March 6.5 call at 10 cents against the stock. This would create an opportunity for 7.46% return in 2 weeks. Now, you would enter this trade by buying stock for $6.14 and selling the March 6.5 call at 10 cents. This trade makes the most money if stock prices finish above $6.50 per share. And I think it has a good shot at it. Fitbit certainly had some, a nice couple of days after earnings, and I expect that to continue. And really, again, this is a 2-week trade, so if it can maintain some momentum over the next 2 weeks, then we have a good shot at creating an unusual or abnormal return in a very short amount of time. And that's what I love about options, is creating those high return environments within shorter time frames. Now, our second trade of the week is going to be a credit spread, and I'm going to one of my favorites. I told you guys, or tell you often, I love trading ETFs. I could do a show every week and only look at 4 or 5 ETFs. I'm more worried that you guys would get bored with it, so I do force myself to find some nice equity trades. But the ETFs are my love. I traded ETF options at the CBOE, at the Chicago Board Options Exchange, back in the early 2000s. And so that's always my go-to. You get great liquidity both in the options themselves and in the underlying if you choose to hedge or trade the underlying. And there's always changes, there's always opportunity. Even when the market doesn't move that much, there's good opportunity. So this week we're looking at the S&P 500 index ETF, the spiders as they're affectionately known. SPY is the symbol, Sam Paul Yellow. Stock ended the week at $280.42. And I'm looking at selling the March 282.5, 283 call spread, collecting 18 cents. And that creates a maximum loss scenario of 32 cents. And of course, this is a March trade, so there's only 2 weeks left. Now, you enter this trade by selling the March 282 half call at $1.19 and then buying the 283 call for $1 and a penny, 101. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices stay below $282.5, $282.50. So if we continue with limited movement in the overall market, this trade pays us well. Over the next 2 weeks, we get to keep that 18 cents. So I like the trade, and let's dive on into the debit spread, a final trade for the week. We're looking at Toll Brothers, symbol TOL, Thomas Oscar Larry. Stock ended the week at $35.46. Toll Brothers is another one of the companies that announced earnings this previous week. And I'm looking at buying the March 36, 35 half put spread, paying 35 cents, and that creates a maximum gain scenario of 15 cents or 42.86% return, almost a 43% return in 2 weeks. Now, you enter this trade by buying the March 36 put for $1.05 and then selling the March 35 half put for 70 cents. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices stay below $35.50 per share. And again, this is an earnings scenario. This stock could have some more moves over the coming weeks. Really, with it being a 2-week trade and it's already in the money, I'm really just looking for stock to either continue going lower, which is the direction that it seems to be going right now, or to just stay still. In either of those scenarios, we collect a roughly 43% return in 2 weeks. So that's the reason why I'm always looking at buying in the money spreads and selling out of the money spreads rather than vice versa. Some people look to buy out of the money spreads, but then it puts you in a scenario where you are hoping that the market moves in the direction of your spread within the time frame of the option before option expiration. All of these options expire in 2 weeks, so most likely next week we will start diving into April trades, because I don't, I've had some wins and I've probably had more losses trading 1 week option scenarios. You have to be careful too. Sometimes the pricing for a company you're not familiar with is priced as almost a lure to get you in, and before the markets coldly snatch the money out of your account. So I'm always, when I see a price in an option or an option spread that seems to be a little too rich or a little too good to be true, I'm constantly just trying to make sure I understand why it's being priced the way it is, because sometimes you do truly find an anomaly that will hold and be a great opportunity for you to make some money. But there are also plenty of times where it's priced that way because of a certain risk that may or may not be seen by the newcomer, and it's a trap. It's a trap. So anyway, that's it. I hope you guys enjoyed this week's show. I am super excited about next week. Next week marks our 52nd show. There will be a contest or a prize of some sort announced. You can expect a couple of things. I will look for help. I need you guys' help in spreading the show. If you enjoy the show every week, share it with friends. And next week, I'm going to give you ideally a way to increase your odds of winning a prize after the show as part of my annual, my anniversary. So we'll get the anniversary episode. Hopefully my trades make money. That always makes me happier. And but I'm looking at possibly giving away I have an unopened Dell laptop. I'm considering tossing in a cash prize that you could certainly use to add to into a option account, or go spend it at your favorite place for consumption and help our GDP, and possibly even a couple of entries into the Option Studio, which will teach you a great framework for being able to trade options profitably as well. And that is an online video course. So we'll see. It's going to be fun either way. Thank you guys so much for listening. And hey, I'm excited. If you have any questions, any thoughts, concerns, or even suggestions for me, feel free to email me. You can reach me, of course, at eric@theweeklyoption.com. Thanks again for listening. You guys have a great week. Happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.